Well, Jan, thank you very much. You follow a lot Argentina's situation. You've been there quite a few times. How do you evaluate Javier Milei administration so far?
Well, the problem is so far it doesn't seem to have a strategy except for dismantling everything which already exists and trying to start over again. And the difficulty is that economies in general are not self-organizing. And if we look at the basis of his policy, which is supposed to be one that is based on free markets and based on prices, we know that most economic theory considers markets as institutions. And institutions need to be built. They don't emerge just out of nothing. So what we're doing is waiting, and presumably that's what the policy is to wait until the economy recovers autonomously. And my prediction would be that in the space of another year to year and a half, you'll discover that there is no autonomous response by the economy to recovery.
So it will not?
It will not. And then the government is either going to have a policy, or the helicopter will come back and it will take Mr. Milei away, just as it took De La Rua away, to some place which is safe.
That's something that we cannot predict, because politically it's very volcanic now in Argentina. But don't you find a strategy in what they are doing in terms of monetary policy, restraining the flow of pesos, locking what they say they are the main sources of monetary emission? Is that a strategy or not?
Well, in a simple sense, it's a strategy, because basically the problem they're facing now is the repayment of external debt. And the problem is that the central bank has, well, if not zero, negative reserves. We're not sure whether it's positive. So the first strategy, the only strategy that I've been able to identify, is the fact of trying to move all of the debt off of the central bank's balance sheet onto the government's balance sheet, and then to refinance in terms of what we call zero interest bonds. So they're trying to avoid what they call this negative monetary creation, which comes from the fact that if you have an outstanding stock of money, and you've borrowed that money at an interest rate, the money supply is automatically going to increase by the interest that you're paying on the debt. Okay? So this is an endogenous source of monetary creation by the central bank. So if you believe that the increase in the stock of money produces inflation, then if you reduce that increase in the money supply, you get the increase down to zero or negative, then you're supposed to get rid of inflation. So what have they done? They've transferred all of the debt to the Treasury. The Treasury now holds the debt, but the debt now is a discount debt, so that the interest is paid when? It's not paid every quarter or every 6 months or every year. It's paid at the end of the maturity of the debt. So basically what you've done is to shut off that automatic increase in the money supply. So this is the first strategy that you can identify as a strategy of combating inflation. The second is to attempt to generate an external surplus. Now, if you generate an external surplus, they haven't managed to do this in a substantial degree as yet, but if you generate that external surplus, it means that you're selling more to the rest of the world, so the rest of the world owes you money, so that they have to pay you money. So what you're getting then is a demand for domestic currency from the rest of the world. You get an appreciation of the exchange rate, and the idea is that the appreciation of the exchange rate will do two things. The first thing, it reduces the prices of imported goods. So again, this is good for inflation. And at the same time, it creates the creation of these external reserves, which gives you the potential for repaying foreign debt. Okay? So if you look, as I say, if you look for an internal strategy, this is the only one that I can find.
And this last one clashes with the capital control they keep.
Exact.
That's why the reserves don't go up, don't recover.
That's exactly right.
And don't you think they will recover in any
Well,
medium term?
the problem is the recovery in the medium term is that the negative part of the appreciation in the exchange rate is the competitiveness of your domestic industry. Okay, so what it does is has an impact on the cost of your imports, but it makes your exports more expensive. So the question is, which one is going to adjust more rapidly? Now, economists have a very simple, well, it's not a simple formula, it's called the Marshall-Lerner conditions. And the Marshall-Lerner conditions that are determined by the response of imports to a change in prices and a response of exports to a change in prices. So that if it turns out that the domestic industry, okay, becomes less competitive more rapidly than the prices of imported goods go down, then instead of having an improvement in the external surplus deteriorates. It gets worse. And if it gets worse, then you have to simply, well, you then lose the benefit of the appreciation of the currency.
You always challenged the idea of inflation as an exclusively monetary phenomenon. And Milei repeats that like a mantra. Inflation is only and every time an exclusively monetary phenomenon. If these strategies you identify fail, will inflation go up again?
Of course, because the entire logic of these proposals is based on the idea that reducing the rate of growth of the domestic money supply is going to cause a reduction in the inflation rate. And as I said, it potentially, theoretically, it could work, but it depends on the movements of the external account and it depends on the movement of internal prices. Now, the difficulty would be is that if it turns out that domestic industry collapses, okay, and what you end up with is a very sharp fall in incomes, and if we look at the poverty levels, we note that the increase in poverty levels are exactly the same as they were in the crisis of the 1999, 2000, 2001. It means that people don't have money. If they don't have money, they're not spending. And if they're not spending, then obviously prices, yes, are going to go down. But the trick in this is to be able to go from the period in which you've reduced prices, you've gotten price stability, to one in which the economy can then expand. So what would happen? If, yes, they're successful, all of these things work very nicely, you end up with negative growth, just as you had in the 2000s.
Higher poverty.
And higher poverty.
Higher unemployment.
Exactly. So the trick now is, will the economy then recover? And the question is, where is the recovery going to come from? Okay, I can still remember walking down the streets in the Microcentro in Buenos Aires after having, well, the dinner at night with the people, the cantoneros, who were out collecting cartons in order to, okay, they're not going to be the ones who are going to be expanding their expenditures in order to generate growth. It's going to be what? It's going to be the industry, domestic industry. But we've just said that the policy of getting inflation down makes domestic industry non-competitive, so that the incentives for investment get destroyed by the policy of reducing inflation.
What about natural resources? They say with gas and lithium we can...
Look, Vaca Muerta, it's been there for, well, I can still remember 5 or 6 years ago,
yes, but 20 years discovered.
When the argument was that inflation was simply caused by energy prices and exploiting the potential for Vaca Muerta, to produce domestic energy self-sufficiency would solve the domestic inflation problem. The problem is that this is not a normal policy element. It's not something that you can decide in the Congress or the president can decide, okay, now we're going to take the oil out of the ground. This is something that's 2, 3, 4 years. And as you say, everybody's known it's been there for at least 10 or 15 years, and it's still there. And it's not, well, they're starting, I mean, as far as I understand, they've started to do some domestic production, but this is not sufficient in order to solve that energy problem. And secondly, it's not something that generates widespread increases in income and demand, because this is what you're going to need in order to recover from the policies. So if you look at oil exploration, it's slightly better than capitalist farming, but not much. That is, the amount of employment creation you get out of this is what? Well, you know, you have some construction, you put in the pipes, you put in the pumping stations and things, but once that's done, you're done. Okay, it's not that this is something that goes on and on forever. Is once you've set up the thing, the oil just comes out. It goes through the pipes and you sell it, and it generates income, but it doesn't generate any employment. And what you need in order to generate your recovery is getting people's incomes to grow again, because the whole logic of the policy of fighting inflation, as we said, produces this sharp decline in domestic incomes. And you have to ask the question, where does recovery come from? Okay. Or if you say that, is the economy self-adjusting? And again, the argument is that normally the economy doesn't self-adjust. It takes something that comes in from the outside. So what's going to come in from the outside? We said certainly it's not going to be coming in from domestic industry increasing investment.
So far, the strategy was not dollarization, as Milei said in the campaign, in the elections, but a sort of fixed exchange rate with this monetary anchor we've been discussing. Can that work?
Here there's also a difficulty in terms of the policy. Remember, we've said that the exchange rate potentially would have a benefit if it appreciates. Now, the problem is to avoid the depreciation that will come before that process of adjustment that we've talked about in terms of the reduction in the rate of growth of the money supply and the improvement in the external balance. So before that happens, what's going to occur? You're going to have inflation rates that are, in general, always going to be higher than the interest rates that the bank is going to be willing to impose. And as a result, there's going to be a tendency towards devaluation. Now, the thing is that if you're a country that has exposure, a debt exposure, in terms of foreign currency, if you're part of the private sector, now leave aside the government indebtedness. If you're exposed in US dollars, okay, and you have to earn pesos in order to pay back those dollars, if you think that the peso is going to devalue, okay, the more it devalues, the more pesos you have to pay in order to extinguish your debt. So there is a very strong incentive to sell your pesos as fast as you possibly can for dollars. This is the classic case, for example, in the Asian crisis. In the end of the 1990s in Thailand, exactly the same thing happened. Thailand had very large external dollar debts. So the domestic residents who used to be able to meet those by exports collapsed. So what did they do? They started selling Thai baht as fast as they could. So the argument is that somehow or other you have to prevent individuals from doing something which is in their own interest, that is paying off that debt as fast as they can. And the reason, the way you do that is by trying to control the devaluation. And this is what they've done. They've set up sort of the equivalent of the tablita. Yeah, which, you know, we've been there before with tablitas and all of these sorts of things. Yes. So what it does is to say, okay, what we're going to do is we're going to try to program that devaluation in order to prevent it going very, very rapidly.
And if this tablita fails, do you think they will back to the original dollarization plan or to another thing?
The problem is that it's very difficult to go to the dollarization plan because, as we said, as far as I understand, the central bank reserves are either zero or negative, one or the other. There aren't any dollars there in order to dollarize.
And can the IMF bring those dollars?
There are not enough dollars that the IMF is going to be willing to bring in order to do this.
Even if Trump wins the election?
Even if Trump wins the election.
Why? Because he did it with Macri.
Well, but he didn't give Macri enough to do that. He simply bailed Macri out. Okay? Because Macri came in with a policy and said, okay, what I'm going to do is to attract foreign investment. And what the IMF did is to say, okay, we'll give you enough money so that the foreign investors have confidence that we can be paid off. So basically what Macri said is that come and invest, go to Vaca Muerta, go do that investment, and don't worry if you want to take your money back, because here, I have this big pot of money that the IMF gave me, and I'm going to give it to you if you want to leave. Okay? Now, in this particular case, it's not that you want that money to take out, you want that money to keep. Okay, those dollars, if you dollarize, you take the dollars in, the dollars are going to stay. They're supposed to satisfy your domestic circulation. And the problem is that the IMF is not going to be willing to give you that amount of money. Why? Because IMF still does what they call DSA, debt stability analysis. Argentina is already in arrears with the IMF. Argentina is already at, I can't remember the exact figure, something like 1,000 and something
Quota.
of its quota.
Yes.
So you can imagine Georgieva, she's going to go to the board and says, okay, we've now lent this money already to Argentina that's 1,000 times more than we should ever have given it. They can't pay it back, and now we're going to give it some more. I simply don't think the staff is going to stand up for that.
Even if Milei represents the interests of Trump or the financial system that the IMF...
No. The problem is the last time the IMF did that, the internal staff apparently made the DSA report and said, no, you shouldn't give the money. In the case, they gave the money anyway, because obviously there were political considerations, there were political pressures. But you can't do that twice, okay? There is a point at which the staff is going to stand up and say, look, you know, why are you making fools out of us? Because we're the ones who submit. You know, if you give the money, it says that we produced an analysis which said that it would be debt sustainable. And obviously it's not. So you're compromising the integrity of the research function of the IMF at this point.
Let's suppose that Argentina gets the dollars from Vaca Muerta, from a foreign investing flow, or from the IMF. Would you suggest dollarization to bring down inflation?
No, obviously not, because again, this is the point. The idea of dollarization is the equivalent of what is argued in terms of Bitcoin. Okay? Well, Bitcoin is supposed to replace gold, and it has a fixed supply. And it's the same argument, is that if you dollarize and you're in a condition where your external balance is probably going to be, at best, to be in equilibrium or negative, it means that you have a fixed domestic money supply. And again, if you're a monetarist, you believe that the price level will respond to the rate of change of the domestic money supply. So if you've got $10 and you haven't got any more, then rate of change of the money supply is zero, so your inflation rate should be zero. Now, the difficulty with that is what? The difficulty with that is what? Is that if that does turn out to be the case, okay, does it come from an adjustment of prices and wages, or does it just come in terms of a change in income? So again, if you end up with the decline in prices, that decline in prices, again, we talked about domestic industry. Domestic industry now has got the expectation of lower sales prices, so that they're only going to invest if they think that there's going to be an increase in demand. But if the lower prices then lead them to decrease wages, because this is what the policy is supposed to do, the wages will adjust downwards if inflation stabilizes, then it means that incomes are lower. So people are going to be spending less. So you're back to the same problem we started out with, is once we solve, if the policy is so fortunate to provide the reduction in the inflation rate that they want, the question is, how do you get the recovery? Because you're getting the reduction in the inflation rate by those very factors that prevent the recovery from occurring. Okay? It's the decline in domestic incomes and employment which allows you to reduce the inflation rate. It doesn't have anything to do with what the money supply turns out to be. It turns out to be what the adjustment process does in terms of domestic demand. And the question is how domestic demand is going to recover. And the only way it recovers is A, the government decides to spend more, which the government has said it doesn't want to do because it's shutting down as fast as it possibly can every kinds of expenditure that the government makes. So if it turns out that they end up with the inflation rate going to stability and you continue with the policy of a government surplus is what? A government surplus says, well, even the incomes that people make, now a higher proportion of those incomes are going to be paid to the government, and the government's not going to spend it. So it's simply
it will spend it, but in interest of debt, of previous debt.
If they're managing to pay back the debt, if they're managing to generate the dollars. But if you're not generating the dollars, this is simply a domestic surplus, and you can't pay anything with a domestic surplus.
They talk about endogenous dollarization, like a dollarization that will happen without a decision of the government. What's that?
Okay, endogenous dollarization. If you go, if you live outside of Latin America and say you want to move, I want to move to Argentina. I want to buy a house. Okay. Yes. What do I see? The prices are all quoted in dollars. Okay. Now, legally or illegally,
yes,
to buy,
yes,
you pay in dollars.
Yes.
Okay. So this is an endogenous dollarization. The real estate market is dollarized. So the point is it possible or probable that eventually, if the inflation rate continues to be very high, that people say, okay, I know that the dollar is going to increase in value relative to the inflation rate, so what I should do is simply convert all of my transactions into dollars. Okay? So instead of only buying houses in dollars, we now buy mate in dollars.
But why people would do that?
They would do that because the value of the dollars don't change. As long as the inflation rate stays high and the peso continues to devalue, okay, the prices in pesos of the mate is going up, your wages are going down. But if you're holding dollars, then the value of the dollar in pesos is going to go up at the same rate as the inflation rate.
But has it happened anywhere?
It could, it doesn't, now has it happened? It always happens is that the black market value of the dollar is eventually going to track what the domestic inflation rate is, okay? So basically what you're doing is I'm trying to protect myself against inflation. So we do that by holding dollars. So the endogenation is to say, well, if it turns out that we don't manage through this policy, I said, of shifting the debt to the treasury and all of that stuff, of getting the inflation rate down, eventually people are going to say, I don't play with pesos at all anymore. I only hold dollars. But automatically, again, the amount of dollars is going to be fixed.
But that's not a strategy, again.
Yes. Yeah, but it's a different strategy than dollarization. I mean, it's different from Cavallo's...
convertibility.
Yeah. Convertibility was to simply say you could have either one and you convert it back to forth. Now you're simply saying no. It just says that if you manage to be able to get a dollar, you keep it and you use it. And eventually, okay, if the situation goes on long enough, it may be the case, as I said, is you go from having houses determined and paid in dollars to having everything determined and paid in dollars. But again, this is a process which is going to, number one, take a very long time. And number two, it depends on what the dollar creation is going to be. And we said, where do you get dollars? Well, the only way you get dollars is either by borrowing them from the IMF. No, that's not a good idea because those you use to pay back the debt, so that doesn't count. So you have to sell exports to do that.
So you see you foresee closer the helicopter than that?
Yeah, I don't, I mean, this is a problem of well, number one, it's a problem of analysis, okay? If you believe that you're going to get rid of the rate of inflation to stabilize the price level by reducing the level of activity, okay, you've got first the political problem that you have to be able to survive long enough, number one, and then number two, you've got the problem of how you generate the recovery, okay?
Yes.
We went through the 2000s when income just didn't, well, in fact, it did not change. Incomes, average incomes went down. Real incomes went down over the so-called lost decade, okay? So, you say, is the government willing to go through a lost decade in which incomes don't go up and in which growth is zero and the economy never recovers? And that's their second problem, because they're counting on the fact that automatically getting the inflation rate to zero is going to generate recovery.
And it's not.
And it never has. I mean, Margaret Thatcher tried this in England. This was the argument that she used. She said, okay, if we get the inflation rate down to zero, then the economy is going to be able to grow. Why? Well, the argument is that if people are not worried about the decline in purchasing power of the peso, okay, or if they have dollars in which the dollar is stabilized, then they don't have to worry about whether you buy this or buy that. Then you can start investing and everything else. But the problem is, with investing, you have to have the expectation of profit. And the expectation of profit means that there's somebody there who has money
To buy.
to buy. And the entire logic of the policy is to eliminate that power to buy in order to get the inflation rate down.
Yeah, I get it.
So,
One last one. How do you think the global financial instability that has risen in the last weeks will impact in Latin America specifically and in Argentina?
yeah, but this is the difficulty that you have, is that you go back to Macri. Okay, Macri had this idea that somehow or other it's going to be external FDI, which is going to come in and save the economy, which was, you know, it was a good idea. The problem is that you have to give foreign investors an incentive to do that. Okay, so if you look now at the conditions in international financial markets, the expectations are all for a return to a reduction in interest rates. And as you go to a reduction in interest rates,
Flight to quality.
that's exactly what happens every time. Okay? Everybody says, oh, you have a crisis in the US. You have a crisis in the US financial system. What happens? Well, it always happens that the dollar appreciates and everybody starts buying treasury bills. And so you sort of scratch your head. You said, I thought the crisis was in the US. I thought the US was having a crisis. Why are you buying US assets? Again, there it is, the flight to quality. Why? Because they know the US government is going to step in and resolve the crisis. They're going to pay off the banks and you're not going to lose any money. Okay? The US can do this. In Argentina, is that likely to happen? No. The government has already said, no, we're not going to intervene to support anything.
So it puts us in a more fragile situation.
Of course. And what it means is it's going to be that much more difficult to generate the dollars that they're presuming are going to result from this policy. Because, as we said, the basic logic of the policy you've got is that the external balance is going to surplus and the domestic balance is going to surplus. Last time that happened in Argentina, who was president? Kirchner.
Yes.
And what happened? You had 10 years of growth that was above 5%, sometimes getting to 8 or 9%. Okay? But how did he do that? He didn't do that by firing everybody. He adopted the Dualde program of the jefes and the jefes.
And fuel the demand.
And fueled demand.
Thank you very much, Jan.
Okay.